You've got these big companies that are saying, I want talent at all costs, and they're doing things that really make no sense. The leading edge of LLMs today are not going to be the leading edge of LLMs tomorrow. So I'm not really sure how relevant these people are in 2 or 3 years' time.
Is there a liquidity drought? Is it going to change? Should we feel sorry for all these rich people?
Welcome to Venture Underground, a new podcast brought to you by Dessel Group. I'm one of your hosts, Sarah Lacey. Each week, Adeo Ressi and I dig deep into the latest deals, news, rumors, and data in the venture capital world to tell you what's really going on. We've both been around a long time, we both know lots of people, and we both are people who like to call it as we see it. This week, we're talking about the liquidity drought. How bad is it? Who's hurting? And who's really causing it?
What's the real reason that companies aren't going public? Well, they don't want to. And they don't need the money.
Have the VCs and companies created this crisis themselves? Later in the show, we talk about whether VCs just fund contrarians or should actually operate as contrarians themselves in their own industry.
Venture is really a business of belief, okay? I tell you a story, and it's a fantastical story.
And at the end of the episode, let's just say things get a little spicy. We're going to get to it right now.
I want to talk about this idea that there's a liquidity drought. Everyone's talking about this great liquidity drought. Pity the VCs and LPs that cannot get these unicorns out into the market. Well, recently there was a story in the New York Times that talked about something they called reverse acquihires, which to me just sound like acquihires on steroids, where Google, Meta, these huge companies are paying hundreds of millions of dollars to VCs to buy AI companies, but basically buy everything but the company. They're licensing the technology, they're buying the founders, they're buying the engineers, they're leaving everything else there. And the speculation is it's kind of a way to go around antitrust and get these companies. And on paper, it's like, okay, this is a win-win-win. The founders are getting paid, the VCs are getting paid, the companies are getting what they want. But it's not really 100% great for startups in the ecosystem. What's your take?
Yeah, I think that is a short-lived fad. The reality is there's a talent war going on. And the way I think things are happening today is you've got these big companies that are saying, I want talent at all costs, and they're doing things that really make no sense. And I see it everywhere. So I know personally some people that actually are supported in having multiple jobs. So like a Stanford professor and works at Google, or, because they want the talent so badly, they're willing to do kind of exceptional things, pay huge amounts of money, make sacrifices on things that seem logical, like buying the company versus doing an acquihire. So I think these are really short-lived, and how they play into liquidity. Of course, if a VC is like, oh my God, the CEO of my portfolio company is getting hired away, I better get a payday here. So they kind of interject themselves in the process to try and walk away with a significant payday when something like that happens. That's understandable, right? Because look, I invested in the company, the leadership's getting poached away by Google. I want to walk away with something, but I really feel that that's a short-lived problem. Again, the talent is only so many great people understand how to build the leading edge LLMs today. But the leading edge of LLMs today are not going to be the leading edge of LLMs tomorrow. So I'm not really sure how relevant these people are in 2 or 3 years' time. Some are going to be relevant, but not many. So I really see that as a short-lived fad. And that's separate than the liquidity crisis.
Yeah. And, the thing that's interesting is to think about, here's the thing that doesn't get talked about a lot, that I think people who've been in Silicon Valley for a long time know. The founders are super duper important. They're like a number one. The money is important, although there's a lot of money, but it's also the people who know how to build a company at scale. You know, the VPs, the ops people, the sales people. I mean, I remember when like Twitter and Tumblr were being built on the West Coast and East Coast. David Karp even said one of the reasons we couldn't scale is because we didn't have the machinery of building businesses at scale, the off-the-shelf VP, all these people that just cycle around. And it strikes me those are the people who get screwed in these kind of things when you take the engineers and there's just a company sitting there.
Sadly, you're right. And that's really the engine of Silicon Valley, these hyper talented people that will jump from scale.ai and then to another company, et cetera. And of course, they get hurt most when there's this acquihire of the top talent. But the reality is right now, Sarah, is not everything you jump into is a hit. Mm-hmm. So you're going to have some hits and some misses. And if you jump into a company and it gets acquihired and it's a miss, you can just as quickly jump into another company and it will become a hit. So there's not a perfect batting average for these top talent. They're going to have some misses. And really, it's shameful that this happened in the first place, but I really think this is an exception, not a rule. And we may see it 2 or 3 times. But I promise you the following statement's true, that it's going to stop dead in its tracks, because back to your point, once if it happens 4, 5, 6 times, the talent is going to become a lot scarcer for companies that look like they might go down this path. And the talent will say, hey, look, I'm not going to stay here. If there's a chance the management's going to be acquihired away, and I'm going to be left holding a dud. So I want some sort of guarantee that I'm either in the acquihire package or you're not going to do an acquihire. And while that hasn't been needed yet, if it happens 1 or 2 more times, that's the next thing that's going to come, and then it's going to put an end to it. So it really has a very finite shelf life. And look, I feel very fortunate right now because we are on the receiving end of some of that amazing talent that's moving around. And I can tell you that is the lifeblood of how these companies are being built. That's why OpenAI and X.AI get built here, and you don't see the equivalent in a place like New York, which is the second largest venture capital market in the US.
All right, so back to the liquidity drought. Is there a liquidity drought? Is it going to change? Should we feel sorry for all these rich people?
There is a liquidity drought. Let's be clear. But it's not. It's very. It's like a barbell. So on one end, with the very large VCs, they're having a lot of trouble getting liquidity because they pumped in tens of billions of dollars into companies that now are very difficult to take public, or very difficult to have an M&A exit with, because they're just extremely overvalued. But on the other side of things, where more rational venture capitalists live, in the emerging manager and smaller fund market, if you happen to invest in one of the companies that become one of these mega unicorns or decacorns, you're sitting on tons of money that you can liquidate right away, right? You can liquidate your position in secondary markets. You can liquidate your position to these larger VCs. So I really think it's like a tale of 2 cities. The big VCs, which really aren't venture capitalists anymore, let's just call a spade a spade. They're investment managers that look more like private equity than classic venture capital. Right? They're in trouble, right? They have very big bets in very big companies that don't have a straightforward liquidity path right now. Public markets aren't really open for them. They're so big. Private markets aren't really open for them, again, because they're so big. It doesn't mean these companies are bad and they're not valuable, but it's just really hard to sell a $10 or $20 billion position in the big company, and these big funds are kind of facing that crisis. But if you're a small fund and you got into one of these deals and you maybe took 1 million and turned it into 50 million, right? There's a lot of ways that you can exit that position, and that's fantastic for you. So I really think it's when you hear about the liquidity crisis today, it's these large funds complaining rather than the reality on the ground.
So that's fascinating. Okay, last question on this. When it used to be, let's go back to like the fervor of the dot-com bubble, Netscape's getting out in 18 months, and then, that cools, and then things get overheated again, but people still aren't going public quickly. And the timeline to going public is like 6 years, 8 years, 10 years. We've all seen the graphs of how long companies are taking to get out, even compared to like early 90s. It's taking longer and longer to get liquidity. Along with this barbell of big fund, small fund, are we going to start seeing the same things with liquidity, where on the big fund level, it's going to start taking 15, 20 years, but on the small fund level, because they're not waiting for IPOs, is it going to be 4 years, 5 years?
That's a very good question. Look, it's taking people a lot. I was just reading about this today on Twitter. There's a whole big thread about like, is it really hard to go public? Why are people waiting to go public? The reality is it's, as hard as it's ever been to go public. Sarbanes-Oxley made it a little harder to go public, but not like massively harder to go public. And so what's the real reason that companies aren't going public? Well, they don't want to, and they don't need the money. So, it's not like, oh my God, what's going on? You have this perfect storm of a situation where the founders kind of don't want to take the companies public because it's a lot of headache, right? They got to do an audit. They got to do this, compliance, all these things.
Let's face it, when you're private, someone who owns 20% of you doesn't have that much say. When you're public, someone who owns 2% of you has a lot of say.
Well, you get sued a lot too when you're public. Oh, you said this, or you did this and it was wrong. It's like, so a lot of founders like, I don't want to go public. Meanwhile, investors are like, great, you don't want to go public. Here's a ton of money to stay private. So they're like, okay, I have a ton of money. I don't need to go public. So now you have these really big companies. They have endless amounts of capital at their disposal. And so there's no real need, desire, or anything to go public. And so they're not going public. It's very simple. Now, if all of a sudden the late stage capital dried up, or large sovereign wealth funds wouldn't back them, or, that they may change their mind and say, oh my God, I have no other choice than to go public to access necessary growth capital. But so when you look at it, I think it's really a combination of founders being like, I don't really want to do this, and the investors creating the perfect environment for them not to do it. Now, you said, so I do think, like, I want to go public, for example. I want to take my startup public, not for a different reason than just I want to go public, like a notch on my belt. I think retail investors should have access to the venture capital asset class, and a great way to do that is by taking the company public. So that's why I'm doing it. And I think founders really need to rethink their own calculus, because if you want to build something that's going to be around for a long time, take your company public, right? That's a big accomplishment as a human being. Now, do I think it's going to create this kind of interesting thing where big funds get big returns and small funds get small returns? The reality is quite the opposite. Small funds get big returns and big funds get small returns. And this is just, math 101. It's very hard to take a $10 billion fund series and turn it into $100 billion. There's just not like that many $100 billion value creation opportunities. There's a few companies that reach that level, right? And at best, you're going to get a double-digit percentage ownership. So it's very hard to turn a $10 billion fund series into 100. But if you're lucky, you can get 20, maybe 30 billion. So you get a 2 or 3x. And if you're lucky. Meanwhile, if you have a $10 million fund, it's very easy to turn that into $100 million. And that happens all the time. So you're seeing right now the big, what's called TVPI or where you take $1 and turn it into $10. That is happening in the smaller emerging manager funds, and definitely not happening in the later stage, larger funds. And that's more of the trend today than anything else.
And what about the time horizons? Do you think the time horizons are going to shrink for the small funds as they don't have to wait for IPOs?
So it's up to the manager of the fund, because what we're seeing right now on the ground is that if you're lucky and you're getting into what are called unicorns, these billion-dollar companies, right? And you came in, let's say you put $1 million to work and suddenly that $1 million is worth 100 million or something to that effect, right? You've got a lot of optionality on what to do to take money off the table, right? There's programmatic secondary sales, right? That's very common. There are new investors coming in that want to buy the shares. There's market-based secondary sales where you can just go out on the market and sell the shares. So you have a huge amount of optionality, but sometimes the manager is like, hey, I don't want to sell right now because I think this company could go to $10 billion. So I really think it's a manager decision on what they want to do. So like we have a fund of funds in one of our the funds that we've invested in. It's in the blockchain world, and it's minting billion-dollar companies. They have many billion-dollar portfolio companies. So much so, they're actively saying maybe we should just take a bunch of secondaries, get some great DPI, like a 3 to 5x DPI, and do our next fund, and we'll still have lots of dry powder in fund one and positions in companies that might still do really well. So it becomes a manager decision, and I think a lot of managers are saying like, look, if I can get the returns, DPI, cash on cash returns for my investors, I should take it. Right. And I don't blame them. It's a good decision.
Yeah. Bird in the hand, as we used to say in the South. All right. I want to talk about something else. We talk all the time about this barbell, particularly within Decil Group, because we like this scrappy end of the barbell, the Rebel Alliance into the barbell. There's one venture fund that has kind of refused to move to either end of the barbell. And hat tip to Eric Newcomer, one of the best reporters in the venture capital scene for my money, although I disagree with his analysis on this, who brought this up. And it's Benchmark, historically one of the best venture funds, who has really refused to move, but they do manage more money. They've moved a little bit, but they've mostly tried to stay with, 5 or 6 partners, equal partnership, classic venture capital. They recently lost some high profile partners, and Eric's argument was in not playing the game on the field, that has hurt them because now they don't have the big AI partner. Sarah Tavel left, some of their big, Bill Gurley's retired, some of these big people that they relied on when you only have a couple partners, when those people are gone, then what are you left with? I disagree with his analysis. My view is, if you had people who brought you these honking huge deals, well, if they left, you still have these honking huge deals. And if you refuse to bloat up your fund, those honking huge deals still can move the needle. Whereas if you had a massive bloated fund and those people left, then those few deals they did that are gargantuan aren't going to move the needle. I would argue those huge deals give them time to find the right talent pick to fill those shoes. Like, I just think you're always better off not having a massive fund.
As we discussed before, I think these massive bloated funds are really not venture capital, right? It's hard to say that a $20 billion fund series is doing venture capital, right? I mean, maybe somewhere in the $20 billion fund series organization, there is something that is closer to venture capital. But if you look at how much money goes into that thing that's closer to venture capital, it's probably the amount of money that the benchmark fund is, right? So, I think if you are a practitioner of venture capital, then you want to have kind of limits on your fund size. And look, here's the reality that I've spoken with tons of LPs, big LPs, small LPs, everything in the middle. And the not so dirty little secret is that, again, the higher your fund size go, the worse your returns are. But there's another issue that happens when that occurs, okay? So you start growing your fund size, right? Your strategy has to change. So if I invest in, let's say, Fund 4, and it's a $500 million fund, and then I invest in Fund 5, and it's $1 billion fund, and I invest in Fund 6, and it's a $5 billion fund series, you've now moved way larger in terms of the amount of money that from a fund to fund series can deploy. So your strategy completely changes. Your team needs to change. All the things you do need to change. And it's not necessarily so clear that that's going to be better for the LPs, better for entrepreneurs, et cetera. So the other firm that's been like benchmark historically is Sequoia. And Sequoia has been very interesting because what you'll see is they'll like go up and then they'll be like, oh, we made a mistake. And they'll like actually return money to LPs. They'll shrink their fund size. They'll say, hey, we over raised for the market. So they're also trying, and it's hard, right? If LPs are throwing money at you, I mean, I'm sure they're sitting in board or partner meetings and like, guys, we could pull down a $7 billion fund here. The fees on that would be pretty remarkable. What does everybody think? And it's a very hard decision to be, no, let's stay at the 300 or 400 or $500 million level. And I think once you cross $500 million, you're leaving that rational venture capital fund size. And a lot of more firms than you think, again, we mentioned too, Sequoia and Benchmark, are making that decision. And ultimately, I think it's the right decision because they're going to stay as a venture capital firm.
And, definitely there are a lot of funds staying in that area. To say there's none is obviously a wild overstatement. But, Sequoia is so interesting. I think it's Doug Leone was quoted as saying, like, there's two rules of venture capital. One is a smaller fund's always going to have returns. And the other is that the rules are always changing and you got to change with it. Like, I think Sequoia wants to be benchmark, but is also like, we're going to play the game on the field. And the question is, do you have to play the game on the field when you're a VC?
I mean, that's a tough one to answer. The way I look at it is absolutely not. And in fact, there's a easy reason why. It's the contrarian bets that make the most money. The Airbnb, the YouTube. I mean, I remember when YouTube came out, you could not actually do it. There was no you or tube because there was like, there was a YouTube. You could put videos there, but smartphones didn't have cameras. You would have to like do it on your camera, put it on a memory stick, put it in your computer, like process it for an obnoxiously long period of time, drag it onto the YouTube thing, have it upload for an obnoxiously long period of time. And this was not a wowing consumer experience. I mean, it was better than what existed before. But the idea that, wow, this is going to scale and everyone's going to make videos and there's going to be like a Mr. Beast. This is fantasy land. But someone saw that, right? Someone, particularly Sequoia, took that contrarian bet. And so for venture, the biggest returns come from these extremely contrarian bets. So it's like dangerous to follow the herd. And look, AI is frankly dangerous for VC because AI is a tool trained on how things were done before. If you're listening to AI, you're at a genuine risk of missing the next big thing because AI is like, oh, this is not going to work. But in fact, it's the contrarian bets that have made venture capital successful.
You've built an organization that uses a lot of AI, and like, I am a writer and I hate AI and I'm like the dinosaur in this place. So, I mean, how do you guard against that? Like, if you are, one of these scrappy venture funds and you're subbing out an analyst for AI tools, how do you guard against that?
Well, I mean, as we're just discussing, don't follow the herd, right? Like, number one. But yeah, with respect to the AI tools themselves, look, if you input so I'll tell you what we do in that specific circumstance. When we ask AI to give a user with our tools opinions on deals, we also ask the AI to make a counterfactual argument, right? So the one thing the AI is very good at is it can make any argument very compelling for or against something. So one of the nice things is we don't just say like, hey, analyze this deal and give us your thoughts, AI, right? We're like, give us an argument and a counterfactual argument to that. And then the manager is the person that decides which strain of the argument they agree with more. And of course, they can use the tools to refine the argument because at the end of the day, there's a human in the middle for the foreseeable future because venture is really a business of belief. Okay. I tell you a story and it's a fantastical story, right? It's like, no way, right? People are going to sleep on other people's couches. People are going to get into strangers' cars to drive them around. Women are going to do this. Women are going to get into strangers' cars to drive them around. Like, yeah, that's going to happen every day. Like, a lot of people are like, that's not going to happen every day. I am 100% confident that's not going to happen. Now, of course, all those things, the naysayers were proven wrong, but there's someone who believes that, right? Obviously, usually it's the founder. Hopefully it's the founder. And then that founder can find that investor that is willing to go on this fantastical ride with them through what most people find crazy and say, okay, I'm going to back you. And that magic, right? When that magic happens, like that's what real venture capital is. That's why these smaller funds are better. Because when you get to these mega fund sizes, right? It's like they have these very junior people that are out there buying options. So they're like some really young kid right out of school is their seed fund or pre-seed person. They're like, I'll write you a check. And what they're doing is they're buying an option. Are they believing in your vision? No. Are they backing you on this journey to change the world and have people sleep on people's couches? No. They're literally buying an option so that later on a more senior partner could pour money in once you've de-risked it.
I mean, they're effectively being human AI. They're pattern matching you against something else and writing you a check in order to later on have the option of putting more money in.
Yep. I mean, sadly, yeah. I mean, you are correct. They're not actually doing what real venture capital is, which is finding these fantastical ideas and willing to go on that journey with the founder to see that fantastical idea through. And by the way, this isn't just limited. I brought up things that are very practical that now seem obvious, like Airbnb, Uber. But this happens in material sciences, like, oh, we can create a thing that does something that seems impossible. It happens in agriculture. It happens in biotech and biosciences. So that fantastical journey is really what, and unfortunately, to your point, Sarah, there's a lot of junior VCs at big firms today that are really just on the, let's buy as many options as possible. So if that idea works out, and so to your earlier question about playing the game, that is a way to play the game. It's like a roulette table, right? A great analogy for venture capital is like a roulette table. So there's different ways to play roulette, right? You could put lots of chips on the board and hope you get hits, right? Which is what this optionality play is. Or you could invest more with conviction and say, hey, this founder has something special. I buy into his or her vision. And so I'm going to back her and really be there on her journey to build something amazing.
I'm going to end it by going back to Benchmark, Sequoia Classic, any of the firms out there that are refusing to scale up. And here's why I'm going to be bullish on them, because even if they have a talent exodus, I think the people who want to do real venture capital are going to wind up going to that firm, and they're going to be talent attractive for the best GPs. Because over the years, I've talked to so many people, and the reason they want to go to a firm like Benchmark is always 5 partners, shared economics. And I think even at these firms that have stacked funds, if you are at your heart a VC who wants to be a VC, that's a really, really hard offer to compete with.
I got to comment on that, though. It can also be very difficult. The story of Benchmark and Uber is not told. I know some inside stuff, and it's hard for me to tell how much of the stuff that I know is true versus like hearsay that gets watered down by being passed. But essentially, there was a lot of disagreement in the partnership around Uber because a lot of people thought, okay, we have this huge company, it should go public, right? And there's other people who are like, no, there's a lot of value being unlocked. And if you read some of the stuff that's been coming out lately about that, most people seem to feel that the decision that was taken actually hurt the long-term value creation of Uber. Like Travis was removed, the company was taken public, and it's doing great. So it's really hard to be like, oh, we could have made more money than the 20,000x that I made as an angel investor, Oh, woe is me. Your 20,000x could have been 40,000x. But that's one of the downsides of a small partnership where everyone has a somewhat of an equal say, is that you can run into these contentious situations like what happened with Uber, where it's very difficult to decide what to do. But ultimately, that's part of the venture capital process, right? You have a fun life, you've got these upside, and you got to make tough decisions, right? And so
you look at it like the Supreme Court, right? When you have really, smart justices who've gone through a vetting process, they have disagreements. Hopefully those disagreements get you to a nuanced outcome. And as the person whose family was threatened by Travis Kalanick, I would say the problem with capping Uber's upside was they had an asshole from a founder, not disagreements in the partnership.
Well, I mean, I would say it was all the above. you know,
They were
you know,
self-inflicted problems.
oh my God. I know. I mean, someday someone's got to unpack what happened there because I mean, there was a lot of dirt that was going on. And, that's, I think, one of our goals here at Venture Underground is to talk about some of these things that are happening as they're happening rather than, 4 or 5 years later when they're kind of the annals of history is rewritten them or whatever. We're going to be covering the things that are happening now that are going to be meaningful in a few years, but kind of give that inside scoop.
But I will say, and I don't say this often, in fairness to Travis Kalanick, I was talking about this yesterday, walking around San Francisco and seeing Waymos. It is almost Shakespearean to see Waymos driving around, potentially the biggest threat to Uber. And what the hill he died on was, we need autonomous cars so much. The reason he ultimately got kicked out was allegedly stealing that technology. And that is now the biggest threat to Uber. I mean, Shakespeare could not write that play better.
Well, and we'll see what happens there. We still, it's very early days on that front. And that is the leading edge of the spear, if you will, of AI, is the fact that these cars are about to become autonomous, right? And there's no human in the middle in Waymo. So that's like, we'll see where that leads us with the rest of the stuff. That will be the subject for another episode.
All right. Well, we will leave it there.
Thank you, guys.
Thanks, everyone.